Gold has been a symbol of wealth and power for millennia, captivating the human imagination and driving economies. Ancient civilizations prized its beauty and rarity, often associating it with the divine and the eternal. They used it to craft intricate jewelry, adorn religious artifacts, and mint coins that were used in trade and commerce. This enduring fascination with gold stems from its inherent properties, which include its luster, malleability, and resistance to tarnish. Gold is durable, divisible, and easily recognizable, making it a practical choice for various applications. These qualities made it an ideal medium of exchange, transcending borders and cultures and facilitating trade across vast distances. For centuries, gold-backed currencies and provided economic stability, serving as a foundation for financial systems worldwide. The gold standard, prevalent in various forms throughout history, directly linked a nation's money supply to its gold reserves, ensuring a stable monetary system. This system brought a measure of predictability to international trade and finance, fostering global economic growth. The allure of gold, however, extends beyond its monetary uses, captivating people with its timeless beauty and intrinsic value. Throughout history, people viewed gold as a safe haven during times of crisis, turning to it when other assets faltered. In periods of war, political upheaval, or economic uncertainty, gold offered a sense of security and stability. People trusted in its enduring value when other forms of wealth, such as paper money or land, became unreliable or devalued. This enduring trust in gold has carried over into the modern era, where it remains a cornerstone of investment strategies. Today, investors still turn to gold as a hedge against inflation, currency devaluation, and systemic risk, recognizing its role in preserving wealth. Gold's historical track record as a store of value continues to make it a compelling asset class, particularly during turbulent economic times when other investments may falter. Its ability to preserve wealth across generations underscores its enduring appeal as a safe haven investment, ensuring that it remains a vital part of financial planning for the future. Economic crises are an inevitable part of the financial cycle, affecting markets and economies worldwide. These periods of uncertainty can be triggered by a multitude of factors, ranging from financial mismanagement to unexpected global events. These might include stock market crashes, currency collapses, or geopolitical events that disrupt the normal flow of trade and finance. During such times, investors often seek assets that can weather the storm and provide a sense of security. Gold has consistently proven to be a reliable safe haven during these periods of economic distress, offering stability when other investments falter. One of gold's key strengths is its negative correlation with other assets like stocks and bonds, making it a unique component of a diversified portfolio. This means that when traditional markets decline, the price of gold tends to rise, acting as a counterbalance to losses in other areas. This inverse relationship makes gold an effective hedge against market volatility, providing a buffer during turbulent times. It provides a cushion to investment portfolios, mitigating losses when other assets falter and ensuring a level of protection. Inflation, the erosion of purchasing power over time, is another significant threat to wealth preservation that investors must consider. Gold has historically served as a hedge against inflation, maintaining its value even as the cost of goods and services increases. Its price tends to increase as the general price level rises, protecting investors' purchasing power and ensuring their wealth is not eroded. This characteristic is particularly important during periods of high inflation or hyperinflation, where the value of fiat currencies can rapidly deteriorate, leaving investors vulnerable. Gold's ability to preserve wealth during economic crises and inflationary periods is well documented, with numerous historical examples to support its reputation. From the Great Depression to the 2008 financial crisis, gold has consistently demonstrated its resilience and reliability as a store of value. This track record of stability has cemented its reputation as a safe haven asset, providing investors with peace of mind during turbulent economic times and ensuring their financial security. Central banks, the guardians of national economies, hold significant reserves of gold. These reserves serve as a crucial component of their monetary policy and overall financial stability. The largest holders of gold reserves include the United States, Germany, Italy, France, and Russia. These countries accumulate and hold gold for several strategic reasons. Firstly, gold provides diversification to a central bank's portfolio. Holding a portion of reserves in gold reduces reliance on a single currency or asset class. This diversification mitigates risk and enhances overall portfolio stability, particularly during times of global economic uncertainty. Secondly, gold acts as a hedge against geopolitical risk. In times of international tension or conflict, the value of traditional assets like currencies and bonds can fluctuate wildly. Gold, however, tends to hold its value or even appreciate during such periods. This stability makes it a valuable asset for central banks seeking to safeguard national wealth during times of global instability. Finally, gold enhances a country's creditworthiness. A substantial gold reserve signals financial strength and stability to international markets. This perception can lead to lower borrowing costs and increased investor confidence in a nation's economy. The strategic importance of gold to central banks underscores its enduring role in the global financial system. Gold versus cash, a tale of two assets. Cash, in the form of fiat currency, is often seen as a safe haven asset. However, unlike gold, cash is susceptible to inflation and devaluation. Over time, the purchasing power of cash erodes as the general price level rises. This means that the same amount of cash buys fewer goods and services in the future. Gold, on the other hand, has historically maintained its purchasing power over long periods. A classic example of this difference is the Roman Empire. A Roman soldier during the reign of Augustus Caesar, from 27 BC to 14 AD, could purchase a high-quality toga, a symbol of Roman citizenship, with one gold aureus coin. Astonishingly, in today's market, one gold aureus coin can still purchase a high-quality men's suit, demonstrating gold's remarkable ability to retain its value over millennia. This example highlights the critical distinction between nominal value and purchasing power. While the nominal value of cash may remain the same, its real value, or purchasing power, can significantly decline over time due to inflation. Gold, being a tangible asset with inherent scarcity, is less susceptible to this erosion of value. This makes it a more reliable store of wealth over the long term, especially during periods of economic uncertainty or high inflation. Seeking refuge, why investors turn to gold. Investors, both individual and institutional, turn to gold during times of economic uncertainty for several reasons. These reasons are deeply rooted in the historical performance and intrinsic qualities of gold. They seek refuge in its stability, its ability to preserve wealth, and its potential for appreciation. Gold has been a trusted store of value for centuries, and its allure remains strong even in modern financial markets. When traditional markets experience volatility, gold often acts as a safe haven, providing a hedge against losses. This is particularly important during times of financial crises, when other assets may lose value rapidly. One of the primary drivers of gold demand during uncertain times is its safe haven status. This status is not just a modern phenomenon but has been observed throughout history. Investors view gold as a store of value that is less correlated with other assets. This low correlation means that gold can provide diversification benefits in an investment portfolio. This means that when stock markets decline, bond yields fall, or currencies depreciate, gold tends to hold its value or even increase in price. This inverse relationship makes gold a valuable tool for risk management. Furthermore, gold is seen as a hedge against inflation. As the cost of living rises, the value of fiat currencies can erode, but gold often retains its purchasing power. When the cost of goods and services rises, the purchasing power of fiat currencies declines. This decline can be mitigated by holding assets like gold, which historically maintain their value. Gold, on the other hand, has historically maintained its purchasing power over time. This makes it a reliable store of value, especially during periods of economic instability. This makes it an attractive investment during periods of high inflation or hyperinflation, when the value of paper money erodes rapidly. In such scenarios, gold can act as a financial lifeline. Finally, investors are drawn to gold's potential for appreciation. While it may not offer the same growth potential as stocks or real estate, gold can still provide significant returns. While gold is not typically viewed as a growth asset like stocks or real estate, it can experience significant price appreciation during periods of economic uncertainty or geopolitical turmoil. This potential for growth adds another layer of appeal. This potential for capital appreciation, coupled with its safe haven status and inflation hedge, makes gold an appealing investment for those seeking to preserve and grow their wealth during turbulent times. In summary, gold's unique characteristics make it a versatile and valuable asset in any investment strategy. If you found this video helpful, please hit the like button, subscribe to our channel, and turn on notifications so you never miss an update.